Morning, everyone, and welcome to this morning's morning market review. Today is Monday, it's the 13th of March. My name is Ross Oshaw, I'm a senior market specialist at FXCM, and my email address is oshaw@fxcm.com. I'm just going to bring up the high-risk investment warning. I'll keep this on screen for a few moments. And if I can just get you guys to confirm, can you hear me, can you see me, and can you see the screen? You can just let me know. Excellent, thanks, Shadrach. Thanks, Quibus. All right, let's bring up the commentaries disclaimer. And I just want to tell you guys that the markets at the moment are extremely tough. They're very, very tough. To be participating in this type of environment, you must be focusing on stop losses and risk management. Every single day seems to bring something new in terms of headlines, and we really got to be very, very careful and cognizant of what's going on in the markets. Things are changing rapidly. I'm just bringing up our references. Hey, Howard, morning to you. All right, let's bring up this chart here. So this is the tradingview.com. I'm actually taking a look at the 2-year yield, the front end of the curve, and you can see this is Thursday, Friday, and over Thursday, Friday, it really the front end of the curve has come down very notably. You can see it's really dropped, and then it gapped open, and the chart underneath is the dollar. As the front end of the yield curve has come down, so the dollar, the correlation coefficient on the daily basis is a strong 74%. And what that is effectively telling me is that the market's starting to reprice in whether there is going to be a strong interest rate hike in March. I think it's the 22nd. But the idea here is there is a repricing of whether the market truly believes there's going to be a hike. Last week we were talking potentially a 50 basis point hike. Then on Friday, we had the non-farm payrolls. The unemployment rate came in high at 3.6%, and the wage inflation, the hourly wages, showed moderation. On top of that, we've seen this banking crisis. It was, I don't know if anybody had heard of Silicon Valley Bank prior to last week, but now everybody's heard about this failure of SVB. And what's happened over the weekend is the Fed's really come to the party. They've started a program. It's called the Bank Term Funding Program. Just taking a look at my notes here. And effectively, it allows loans to be taken up to a year. It's ensuring that banks don't have to embark on any fire sales. They don't have to sell any of their assets to meet liquidity needs. So as soon as there is some sort of run on the bank and there's no liquidity, they want to make sure that the bank doesn't have to embark on some sort of fire sale. So that's really helped calm the markets. There's a 25 billion backstop to the BTFP as well. So the Fed really trying to mitigate any risk of contagion. So the idea here is that this Silicon Valley Bank really has brought with it the risk of contagion. We've already seen another bank actually close. In New York, there's a bank called Signature Bank, which has now been closed, but the deposits there have been made whole. In other words, if anyone's got a deposit with Signature Bank, they'll be able to draw on those deposits. And the Fed's really gone a long way to ensuring that the contagion is contained. However, take a look at the front end of the curve again, the front end of the curve suggesting with this banking crisis and with the moderation in wage inflation and with the slight increase in the unemployment rate, 50 basis points seems to be taken off the table. And if 50 basis points taken off the table, the question now is there a pause or is there still going to be 25 basis points? So at the moment, I think we've still priced in 25 basis points, but we're going to watch it very, very carefully. Now, what does that mean? It means that last week the markets were pricing in 50. Now they're repricing in, and you can see that repricing in has pushed the greenback down. Okay, so let's take a look at a couple of the other instruments here. Let's take a look at NASDAQ, which is very sensitive to interest rates as well. So I'm just going to bring up NAS 100 here. All right, and you can see that today the Nasdaq's showing some blue. Okay, we're going to do a analysis in a moment, a top-down analysis. But let's just take a look at this in terms of the correlation coefficient. Changes to NAS 100 as well. All right. It's very interesting. It's still negative. It's not such a strong correlation on the daily. It's only minus 21%. Let's just take a look at this on the weekly. Very strange. It's actually positive on the weekly. So the correlation here between the front end and the Nasdaq, not that strong. I would suspect we've got a stronger correlation here on the longer term. We're usually looking at the real rate. We're usually looking at the 10-year real rate. What's the difference? Well, when you're discounting the stock market, you generally do it with a 10-year rate because stock market's generally a longer term investment. So perhaps we're not looking at this in terms of the correct term here. But incidentally, as the short term has come down, we are seeing that some blue on the Nasdaq. Let's just take a look at Euro US dollar as well. All right, and let's bring in the correlation coefficient there as well. And yeah, you can see it's a strong inverse relationship. So the currency market's very much in tune with what's happening on that front end of that curve. And that front end of the curve is very much dependent on that hiking cycle of the Fed. And now that hiking cycle of the Fed starting to be repriced. That's very important. Very difficult because now we've got to come up with an idea of what the Fed's going to do. And that's not going to be easy because tomorrow we've got another data point. Tomorrow we've got inflation data coming out. And then inflation data is the next piece of the puzzle. So again, I want to reiterate, very difficult environment. Let's go through to this chart over here and let's start doing a top-down analysis. Let's start with the Nasdaq and then we'll go into DAX. And what I'm keeping an eye on here is the longer-term trend of the Nasdaq. We've got a higher trough, higher peak, and you can see we've come back into this support area. So it's really resistance, turn support. And if I just bring up Microsoft Paint, what we're looking at, I just want to show you this in a sort of a theoretical basis. You kind of get these movements here. Now, what you do is you look at the previous peak. Okay, it's called the principle of polarity. You want to see the pullback. I'll make this red, and then you want to see if we can get the next impulse off. That's what's happening here. Okay, so we pull back. Here's the principle of polarity, and now the question is, are we going to get this movement up? And I suspect it really depends very much on the interest rate cycle at the moment, and that interest rate cycle at the moment very much dependent on the inflation data that comes out tomorrow. Remember, last week the Fed was very aggressive, very hawkish. Come Friday, come SVB, okay, things are starting to reprice again. Every single day the market's changing. It's a very difficult environment to be in. If we look at this in terms of technicals, let's just go down to the daily chart here. All right, and what we can do here is draw in a line like that. And what I want to do is I want to draw in a parallel line, and you can see we've got a flag. See that? We've got a flag. So in terms of technicals, the Nasdaq does look like it's embarking on some sort of continuation pattern here. And I think that if the 25 basis points is taken off the table, we've got to watch it very carefully. Then that acts as a tailwind, potentially lifts the Nasdaq up. If we go down to the daily chart here, okay, you can see that it's now looking to perhaps cross out of zone 3, which is the bearish area, cross into neutral. Well, a movement from the bearish into neutral, well, that's a relative step forward. So we may see the flag pattern. This is a flag pattern starting to push up now, and we want to see if it can make its way into zone 1, which is our bullish channel. So a lot of sort of unknowns, a lot of variables that we're looking at the moment. All we can say is that we've pulled back to support. We want to see if that support is strong enough and if it brings some bulls in from the sidelines. Let's take a look at the DAX. Okay, I want to go to a weekly chart here. Now the DAX had been a very strong market performer over the last, let's call it the last 5 months or so, since the low of October. You can just see this is a really strong looking higher trough, higher peak. This over here, let's take this higher trough out. Let's just take a look at where we are right here, and we'll take a look at it in terms of this type of a chart. So the DAX now, very difficult to make money on the DAX because we're moving in that sideways pattern. As long as we have the sideways pattern, you're trying to trade between support and resistance. It sounds easy on paper. It's very difficult to do practically. Trends are much easier to trade because trends, a rising tide lifts all boats, as they say. So the idea here is that we've moved into, so we do have a primary trend up, but we've moved into a sideways pattern here. That makes trading very difficult. But if we go down to the hourly here, this is interesting. There's this huge gap open. Okay, there's this huge gap open, and in fact, you can see that there is a lot of underlying positive momentum as long as the stochastic stays above 80, and that's key. It's got to stay above 80. Then we probably get a bounce off of the R1 level. So that R1 acting as support at the moment. But it really depends on that underlying support, and that underlying support is going to be telegraphed to us via the stochastic. Okay, there's no such thing as overbought on the stochastic. When you go above 80 on the stochastic, it's telling you that there's an underlying strong momentum. That's where we are right now. And you can see there's actually a buying tail there as well. We've got about 3 minutes to the cash open, and there does seem to be pre-positioning into the DAX, and it looks as if the market wants to take it higher. Why does it want to take it higher? Well, there's this repricing in the markets in terms of interest rates. That repricing in interest rates is very important because that is really what's driving the markets at the moment. Let's just take a look where it's sitting in terms of the zones. It's sitting in no man's land, but okay, the idea is it has moved from weak into neutral. That is a step forward. It all now depends. Okay, we've got just over a minute to cash open, just to see if we can stay in this upper quintile. You can see what happens when you stay in the upper quintile. So if we go back to this point over here, okay, this is a good example. Okay. That's where the magic happens, okay? When there's an underlying momentum. When the momentum's in the upper quintile, that means in the top fifth of the y-axis. Okay, so we pretty much got a nice movement here. It's all about now the risk on. It's all about the risk on sentiment sticking. And let's see if we stick. Remember, tomorrow's a big day. Inflation. Let's just take a look at euro US dollar as well, please. Okay, we're going to do a top down here. All right, so this is very interesting. We've got a series of higher troughs, higher peaks. This over here, this higher trough, I'm going to keep this. I'm going to keep this as a question mark for the time being. We'll only know at the end of the week if we've got the next higher trough here. And the way we'll know that is if the euro US dollar closes above the high of the reference candle, and the big variable behind that's going to be inflation. The big variable, but at the moment it does look like it's trying desperately to make the next the next higher trough in the series. If we go through to our daily chart, you can see that it's pushed now into zone 1. Zone 1 is our bullish area. Let's zoom in there, sitting nicely. And if we go down to the hourly chart, okay, you can see that we're building a momentum here. Okay, there's the momentum. So as long as we stay in this upper quintile, as long as we stay there, then we potentially have that swing going. Okay, so the cash market's just opened. Let's just take a look, see what's happening on the DAX side, and then we'll conclude. All right, so what we can do here is monitor the stochastic. We want to see if the momentum holds, and we can take a look and see if we get price taking out the previous hour's high. If we get it taking out the previous hour's high, then potentially we're getting the momentum building. So at the moment, it's all a little higgledy-piggledy. That's because I think a lot of the algos, a lot of the preset orders are starting to trigger. If we just let that settle for a bit, and then we can see if the market direction is in fact on the bullish side, or if this is acting as some sort of dead cat bounce. All right. So I think that's where we'll leave it for this morning. If there's any questions, please go ahead and type those through. Any questions? Please go ahead and type those through. All right, nothing coming in. So let's conclude at this point. I want to wish you guys a good day, a good evening ahead. We shall speak tomorrow. Tomorrow is a big day with inflation up. Thanks very much, guys.